Guys, welcome to my YouTube channel. Today's topic we are going to discuss the risk of selling puts. Selling put is considered one of the safest strategy in options. However, there are some risks still associated to this strategy, and that's exactly what we are going to discuss in this video. So let's start. Okay, so what is selling put? Let's quickly go through that so we are clear what exactly is selling put. So selling put, essentially what it means is you are getting into a contract where you are agreeing to buy a particular stock at a particular strike price, right? So let's say for example a Tesla, and you are you're getting into the contract and agreeing to buy Tesla for, let's say, $300, right? So that is the obligation that you are getting into, and that's exactly what selling put is, right? The second thing is because you are signing that contract, you get to pay a premium because you are agreeing to buy some underlying at a particular strike price, right? So for that you're getting a premium, and it is considered a bullish strategy because as long as at the expiry, if the stock happens to be higher than your strike price, then you get to collect all the premium and your collateral is released, right? So that's why it is considered a safe strategy. Okay, let's take an example of this, right? So we'll take an example of NEO. So you're basically buying a sell put contract of NEO. Your strike price is $11. For that the premium is 26, which is for 100 stocks it would be $26, and the expiration is 4th of August. For this the total collateral you're putting is $1100, and you're getting a premium of $26. So now in this scenario, what are the possibilities that can happen, right? So there are three things that can happen. At the expiry, either the stock price could go higher than your strike price, so it could go to, let's say, $12. In that case you are safe. There is because the contract expires worthless, you get to keep the premium, all good, right? Now consider the second scenario where your stock price and the strike price are exactly same. In that case also, most of the time this will be a worthless contract because anyone who bought that put will not exercise that contract anyway, right? So you're safe in that. Now the third scenario where the stock goes below your strike price, that's where you are at risk, right? You're getting you are a risk at assignment. So that's what we are going to discuss on what happens if the stock drops and it goes below the strike price. Very first risk, like we discussed in the example, right? You are, because the contract was that you are obligated to buy the NEO stock at $11 per share, even though the current market price for that share is $10, right? So you are obligated to buy that stock. That's the risk you are at. And the another thing with selling put is your potential profit, right? The premium that you receive it will be less compared to the other options strategies, right? So your basically your profit is capped. No matter where the stock end up with, your profit is capped. Let's say NEO shoots up suddenly, right, to $14, $15, right? But for you it's still those premium that you received, right? So that's the potential profit is capped. Let's consider the NEO example again, right? So what happens if the NEO price drops to $10, right? So in that case you are basically assigned 100 share of NEO with average price of 11, even though the current market price is $10, which is below your strike price, right? So you are right away at the loss of $100 because you're getting assigned NEO at $11 and market price is going on right now is $10, right? So that's the risk. So how do we mitigate this risk? Let's discuss that. Okay, now let's look at how you can mitigate your risk. You cannot completely avoid anything in the stock market because you cannot predict what's going to happen. So it's always good to be prepared and see how you can avoid or mitigate the risk and minimize your losses, right? So the first point is you only sell put for the stock that you really want to own. Do not sell puts on a stock that you don't want to own in your portfolio, right? So because there is always a risk of the stocks getting assigned, and if you don't like the stock for any reason and you cannot get rid of the stock, then you're just stuck. So to begin with, the very first point when in the selling put strategy, that you only sell put on a stock that you want to own. Let's say for example Apple, right? And you want you want that stock at a particular price, you sell the put. Even if you assign, you don't care because that's the stock you anyway wanted, right? The second point is let's say that the strike price that you sold the put for is not really and it had the stock has gone way below that stock strike price, but you expect that in a week or a 2 week time frame the stock may bounce back, right? So in that scenario in particular, what you can do is you can roll out your option. You can roll out the option to a week, to 2 week, or even a month out, right? So that is one other strategy that you can use to kind of reduce your losses, or you can even get a credit. Let's say if you roll that option out to couple of weeks, you may get credit back, so you are not losing anything, you're just delaying the assignment, right? So even after 2 weeks, stock may go higher and you are all good, right? So you are not losing any money in that case. So that is another way you can actually minimize the risk of stocks getting assigned which you don't want. By the way, if you want to know how to roll out an option, I have already created a detailed video on that, and I'll put the link in the description below, or you can find somewhere in the screen as well. So do check that out if you want to understand how to roll an option out in a future date. The third and the last one is let's say that you anyway get assigned that stock, right? And you still want to generate some income of that. So what you can do is you start selling the covered call on that stock. So you don't really have to sit on that stock and hoping for it to go up. You can always sell covered call on that stock. And that is all for this video. If you have stick around so far, then I hope you got some value out of it. If you like the content, then please consider subscribing, and if you have any questions, then please feel free to comment. I do look at the comments and answer. Happy investing and take care, folks. Bye bye.